Barclays' wife says big tech inflows save America. It's helped the overall U.S. outperformance of late. UBS says the tech rally has legs. We said Microsoft hits a new high. NVIDIA's not that far away. How do you see it?
That's how I see it. I run a concentrated book, and most of my book is in big cap tech. So to me, they're permanent compounders, and sure, valuation gets stretched every so often, but they eventually grow into that valuation. Plus, they've got the best balance sheets. They spend for growth, which is what their AI spending is, and the concerns about will they make money off of it, I think, are misplaced. They will. The timing is an issue, but they will make money off of it. So I don't know. I know why you want to be in other areas, as I am, and some of those areas that you mentioned, frankly. Yeah. But at the end of the day, they're just permanent compounders that deserve, by and large, the multiples they get. So why stray?
So let's bring in the person I suggested thinks we are going to go not only to new highs, but well beyond that. He's Brian Belski. He has raised his S&P target now back to 6,700. He joins us by the phone. So you're playing this game. I mean, the market goes up and you reversed course here. Why?
Great question. Thank you so much for having us. I know you love it when I say it, but I'm humbled to be on. We wrote a piece 3 weeks ago, Scott, and kind of detailed what we needed to see in terms of signposts with respect to be bullish. Now, coulda, shoulda, woulda in terms of raising our targets a while ago. We wanted to make sure that we started to hear more about companies providing guidance. We wanted to hear more about and see actually less the law of diminishing returns in terms of the rhetoric and noise out of Washington. And then lastly, in terms of our own fundamental work, which we've been publishing for a long time, when we take a look at earnings, which is a cornerstone to why we continue to be long tech, communication services, financials, and discretionary is for years and years and years, part of our process has been looking at earnings revisions. And earnings revisions for the majority of these sectors, especially tech, have bottomed and are going to, we believe, begin to go up a lot. So we think at the end, the last 6 months of the year, so the next 2 quarters, we actually think financials is the area where analyst numbers are still way too low, that we're going to see a lot of very strong balance sheet and cash flow there that is going to drive earnings going forward. So that's why we are overweight those 4 sectors. And, oh, by the way, from a fundamental bottoms-up perspective, that's why we still like the market. And, oh, by the way, have the entire time. When we did lower our target, by the way, in April, we made a comment. We said we own what we own. We made no changes to our portfolios or allocations. So April, May, June have been one of the best performing quarters of me running money as a published analyst for over 20 years. So we were right to remain prudently bullish, and now we're just adjusting our target as such.
I'm just wondering if you're in any way premature in doing so. And the only reason I ask that is because if you're making a declarative statement that guidance is going to be good, how do you know? Number one, earnings season hasn't even started yet. You're making a declarative statement that there's more bark from bite from whatever happens out of D.C. How do you know? We don't know what the ultimate levels on tariffs are going to be. The market obviously appears to be somewhat desensitized to that. We don't know the end game to the big, beautiful bill. And when you declare that the death of American exceptionalism, as you have today, was widely exaggerated and too vehemently applauded, these are your words, to hold any merit or duration in our view. I mean, there has been something going on with the bond market and the dollar. So you make very clear statements here that I'm wondering why you're not at risk of being too early.
Thanks for asking that. I really appreciate that. You know, as you know, my job is to be the chief investment strategist for BMO Capital Markets. We have the great fortune of traveling around the world and talking to clients all over the world, my institutional clients. We also know our institutional clients are massively overexposed China and Europe. And because they left America, not because of fundamental reasons, but because of other reasons, they've been reluctant buyers of U.S. stocks for over 20 years, and they saw their opportunity to do so. Now we've seen the relative performance of those areas begin to suffer greatly. We've also seen the relative performance of the dollar. The majority of its losses were actually done the first 4 months of the year, Scott, something we talked about last time when we were on your show. In terms of the bond market, we are seeing some solidification, which we've said now since November of 2022 that we believe that 10-year treasuries are going to be entering a range between 350 and 450. From a normalization pattern, which we do believe that the major trend in markets the next 5 years is normalization, that's a pretty good environment to be in. Lastly, in terms of guidance, when you take a look at charts, right, we are not technicians, we are not chart followers or affirmation confirmation. At the end of the day, we like to be more contrarian. If you take a look at the number of companies in the S&P 500 that are actually providing guidance, it's beginning to, not providing guidance, it's bottoming out. You want to buy things on the turn. So we believe that more companies are going to be, we're getting ahead of this because that's investing. You want to be before things happen. Companies are going to be providing more guidance in second quarter. Financials are going to crush the numbers. Financial companies are going to be the first to provide guidance for the rest of the year, and the market can, will, and should applaud that.
Weiss has something for you, B. Go ahead.
Yeah, it's kind of interesting to talk about guidance when we've been in a quiet period for about 2 weeks and companies haven't even been able to talk to anybody about guidance. And as you go and look at the guidance going forward, you have to make the assumption that we're going to get an awful lot of trade deals in the next week, or that tariffs are going to come in big time on July 9th, or Trump is going to push it forward. And given how unpredictable this administration is, what I come out with, because I also don't agree with your statement that it was vehemently applauded that American exceptionalism is dead. I think that headline rather, lasted for all of 2 minutes. So to me, Brian, and I'm humbled to be able to put this to you this way, is that you came to your conclusion first, then looked for a way to support it, and that way to support it is built on a house of cards or uncertainty. So you're making a bet, and I get that, and that's what you do for a living. That's what I do. But I just don't think you have the ammunition at this point in time to make that bet.
Well, thanks for your comments, Steve. I appreciate that. But what we do is research. We look at all 500 companies in the S&P 500. We also run all cap money, so we look at another 1,000 companies. So I have a team that scours through earnings releases. I know we're in a 2-week quiet period, but not all companies report on a calendar basis, Steve. Also, with respect to, you have to also, as I said in my comments to Scott and what we've written, you have to dovetail and combine what earnings revisions are actually doing, Steve, which the path of guidance. So sometimes you do have to make a call. A house of cards, I think, is too strong. We're not going to comment on politics because I think what politics, again, have proved this year is that politics have nothing to do with the absolute performance of the stock market. It can either enhance or detract. It's been proven out this year. I'm not a politician. No, I'm not a politician. Steve, can I speak, please? Listen, I am an analyst. I'm a published analyst. We've done the work. We've proven ourselves. We have a published track record. I speak what I speak. I say what I mean, and it's been proven. And it's been proven in my results. So you can punch holes in it as much as you want. It doesn't do anybody any good. I appreciate your side of the story.
B, so you're with us on Friday. I'm going to give Joe Turnova has a question for you, too. Well, let's do that, and then I'm going to get to some news in a moment. But go ahead.
Brian, third quarter debt issuance rises significantly for governments, corporations. Where are you on the relationship between rising debt issuance, yields that potentially could rise, not just here, but around the world, and that relationship with equities?
It's a great question, Joe. Nice to hear your voice. We published this thing called the U.S. Chart Book, and we have a page for every single sector where we look at the operating performance of sectors. And if you take a look at where free cash flow is and where debt to equity is, the majority of debt to equity ratios for the majority of sectors, excluding utilities, straight down. Free cash flow straight up. In terms of debt issuance, we'll see with respect to what's going to happen with the Fed. Our call is not encumbered on the Fed cutting rates. Our call is all about what we're seeing in earnings and what we're hearing from companies. So I do believe that from a corporate perspective, in terms of the actual financial statements of a company and a sector which we look at, we think the U.S. companies are very well positioned.
All right, we'll leave it there. Brian, thanks for calling in. We're humbled that you're so humbled to be on. We are, and we'll see you in person, I think, on Friday, which is even better that we get to see your face and not only hear your voice. That's Brian Belski at BMO.